Strategist and Managing Director Aditya Narain, the market veteran, was the CNBC TV18 guest editor through the day. And despite all the gloom and doom around, Narain is still betting on a 20% return from the market this year. Take a look at the CNBC TV18 exclusive.
It may not be a bear market, but the volatility is real and it's here to stay. That's how CITI is reading the current collapse in markets around the world, including India. China is at the epicenter, and CITI's India MD Aditya Narain feels the economic adjustment that the world's second largest economy is going through could lead to some more volatility.
So, to some extent, we've been a little cautious on the currency. We've seen a certain amount of downside there. We didn't think it would come in such a jerky manner. In fact, our initial read was that it would all happen then, and after that we thought it would stretch out a bit. But yes, it's tended to be very jerky in the immediate term. But we do see a certain amount of weakness, on the yuan.
So does this mean more pain for India? Not necessarily, says Narain. He cites a number of factors. To begin with, the fact that domestic investors have provided plenty of support to the market at a time when foreign investors have turned away.
I think the big change really is that the base has flipped. The second bit is a lot of the domestic money that has actually come in over the last 6 to 12 months has actually not done as badly as the top-down sense is. A lot of the market has actually done well. A lot of the smaller and mid-caps have done even better, which is where a lot of this money is going in.
Another positive is the tempering of earnings expectations.
That most numbers, if you see, for the market for FY17 range between 18 to 20% for the Sensex. But there is actually a kind of a presumption that these numbers will effectively get cut. And I think that's a nice position to be in.
That's why CITI is expecting a 20% return from the market this year. The brokerage's December 2016 target stands at 32,000 based on 16 times one-year forward earnings. It's optimistic on financials, autos, energy, cement, utilities and pharma stocks. But Narain points to one vulnerability. The commodity fall advantage, he feels, could have run its course and may just start working against market returns if prices continue to crash.
That you already have a banking sector that's kind of pushed to the wall, and these added stresses, start building up a little bit. So in some senses, while there'll always be arguments for, further weakness in commodities helping the big picture India, I think you've reached a situation where the dislocation because of these drops is now beginning to actually hurt.
Despite the challenges, CITI maintains a positive view in the current downtrend. Narain, however, adds that 2016 will be a stock picker's year. He says this won't be an easy market where you can ride one big thematic wave, but one in which investors will have to work with multiple themes and stories in specific stocks and sectors to pocket smart returns. Bureau Report, CNBC TV18.
Well, a stock